Nvidia just hit a market cap that's bigger than the entire GDP of most countries. But here's what nobody's telling you. We might be watching the biggest bubble in tech history unfold right before our eyes. I'm talking about valuations so insane that even seasoned Wall Street veterans are sounding alarm bells. But wait. Before you think this is just another Nvidia is overvalued rant, I'm going to show you something that'll blow your mind. The math behind Nvidia's current price suggests something that should terrify every investor. And by the end of this video, you'll understand why some of the smartest money managers on the planet are quietly preparing for what could be the most spectacular crash since the dot-com bubble. Hi, I'm Mark. And over the past 3 decades, I've watched markets go from rational to ridiculous more times than I can count. I've seen the dot-com crash, the 2008 financial crisis, and countless bubbles burst. But what's happening with Nvidia right now? This feels different and potentially more dangerous. See, I remember back in 1999 when everyone thought Pets.com was the future of retail. People were throwing money at anything with Hog.com in the name, convinced that traditional valuation metrics didn't apply to the new economy. Sound familiar? Because that's exactly what's happening with AI stocks today, and Nvidia is leading the charge. Let me put Nvidia's current valuation into perspective for you. As I'm recording this, Nvidia is trading at a market cap of over $1.7 trillion. To put that in context, that's more than the entire GDP of Canada. It's bigger than the combined value of Walmart, JP Morgan Chase, and Coca-Cola put together. But here's where it gets really wild. Nvidia is currently trading at roughly 60 times its earnings. Now, I know what you're thinking. Mark, that's not that crazy for a growth stock. But hang on, because this is where the story takes a dark turn. Let me show you something that should make every investor pause. In 2000, Cisco Systems, the darling of the internet boom, was trading at similar valuations. Everyone said Cisco was different, that it was the backbone of the internet revolution. The stock hit $80 a share in March 2000. Want to know what happened next? It took Cisco 17 years to get back to that price. And here's the kicker. Cisco actually was building the internet's infrastructure. They weren't just riding a hype wave. They were fundamental to the technology revolution. Yet even with all that real value, the stock was simply priced for perfection. And when perfection didn't arrive fast enough, reality came crashing down. Now, before you start thinking I'm just another Nvidia bear, let me tell you something that's going to surprise you. I actually think Nvidia is an incredible company with revolutionary technology. But that's not the question we should be asking. The question is, at what price does even the best company become a terrible investment? And I'm about to show you some math that'll keep you up at night. Let's do some simple calculations that Wall Street doesn't want you to see. Nvidia's current market cap implies that investors believe the company will generate absolutely massive profits for decades to come. But how massive are we talking? If we assume Nvidia needs to justify its current valuation with earnings growth, the company would need to grow its profits by roughly 20 to 25% annually for the next 15 years. That means Nvidia would need to generate over $200 billion in annual profits by 2038. To put that in perspective, that's more than Apple, Microsoft, and Google's current profits combined. We're essentially betting that Nvidia will become more profitable than 3 of the most successful companies in human history, all at the same time. But wait, it gets worse. For Nvidia to hit those profit targets, the entire AI market would need to grow to astronomical proportions. We're talking about an AI market that would need to be worth trillions of dollars annually, Now, I'm not saying AI won't be huge. It absolutely will be. But markets don't grow in straight lines. And they certainly don't grow without competition, regulation, and technological disruption along the way. This reminds me of a conversation I had with a tech executive back in 2007. He was absolutely convinced that housing prices would never go down because everyone needs a place to live. The fundamentals seemed solid, the growth story made sense, and everyone was making money. 6 months later, his company was bankrupt, and he lost everything in real estate investments. The lesson: even the best long-term trends can experience brutal short-term corrections, especially when valuations get ahead of reality. Here's where most financial YouTubers would tell you to sell everything and run for the hills. But I'm not going to do that, because the truth is more nuanced than the bears want you to believe. See, there's something else happening behind the scenes that could make this situation even more explosive. And I'm not talking about what you think. The real danger isn't just Nvidia's valuation. It's what Nvidia's success has done to the entire market. Right now, the S&P 500's performance is being driven by a handful of mega-cap tech stocks, with Nvidia leading the charge. When one stock has this much influence over the entire market, we're not just talking about Nvidia risk. We're talking about systemic risk. Here's a stat that should terrify you. Nvidia alone now represents over 7% of the S&P 500. That means your diversified index fund is essentially making a massive bet on one company's ability to justify a $1 trillion-plus valuation. But the rabbit hole goes even deeper. Nvidia's success has created what I call the AI everything bubble. Companies are slapping AI onto their business descriptions and watching their stock prices soar, even when their actual AI capabilities are minimal. I've seen this movie before. In the dot-com era, companies would add .com to their name and see instant stock price jumps. Today, it's AI-powered this and machine learning that. The market is rewarding AI exposure regardless of fundamentals, and that's a classic sign of bubble behavior. Now, here's something that's going to shock you. Despite all this talk about Nvidia being overvalued, there's actually a case to be made that the stock could go even higher in the short term. You see, we're in what behavioral economists call a momentum trap. Nvidia's stock price keeps rising, which attracts more buyers, which pushes the price higher, which attracts even more buyers. It's a self-reinforcing cycle that can persist much longer than rational investors expect. I've learned over the years that markets can stay irrational longer than you can stay solvent. The question isn't whether Nvidia is overvalued. It clearly is by traditional metrics. The question is, how long can this irrationality persist? Here's what's really interesting. While retail investors are piling into Nvidia, some of the smartest institutional investors are quietly doing something different. They're not necessarily selling Nvidia. That would be career suicide if the stock keeps climbing. Instead, they're hedging their positions and preparing for multiple scenarios. Professional money managers are using strategies that most retail investors don't even know exist. They're buying Nvidia for the upside, but simultaneously purchasing put options or shorting related stocks to limit their downside risk. It's like having your cake and eating it too. But it requires sophisticated knowledge that most individual investors simply don't have. But there's another factor that could completely change the game, and it's one that most investors are ignoring: government regulation. Nvidia's dominance in AI chips is so complete that it's starting to attract attention from antitrust regulators. The company controls roughly 80% of the high-end AI chip market. Historically, When any company achieves this level of market dominance in a critical technology, governments start asking uncomfortable questions. And there's something happening in Washington right now that could completely reshape Nvidia's future. But I'll get to that in just a moment. First, let's talk about the elephant in the room. China. A significant portion of Nvidia's revenue growth has been driven by Chinese companies desperate to build their own AI capabilities. But geopolitical tensions are escalating, and export restrictions are tightening. What happens to Nvidia's growth story if they lose access to the Chinese market? Or if China successfully develops competitive domestic alternatives? These aren't hypothetical scenarios. They're real risks that could materialize much faster than investors expect. Now, I want to be crystal clear about something. I'm not saying Nvidia is going to zero or that AI is a fad. Artificial intelligence is genuinely revolutionary, and Nvidia has built incredible competitive advantages. But here's the uncomfortable truth that nobody wants to discuss. Even revolutionary companies can be terrible investments if you pay too much for them. Let me tell you about Amazon. In 2000, Amazon was trading at over $100 per share. Then the dot-com bubble burst and the stock fell to under $6. It took Amazon nearly a decade to recover to those 2000 highs. Was Amazon a bad company? Absolutely not. Did it revolutionize retail and cloud computing? Absolutely. But if you bought at the peak in 2000, you endured a decade of losses despite backing one of the most successful companies in history. This is what I call the valuation trap. Investors get so caught up in a company's potential that they forget about price. They assume that if a company is going to be successful in the future, the current stock price doesn't matter. But price always matters. Always. So what are the warning signs that we're in bubble territory? I've identified 5 key indicators, and Nvidia checks every single box. First, extreme valuations relative to current earnings. Second, widespread belief that this time is different. Third, retail investor FOMO driving trading volume. Fourth, media coverage reaching fever pitch levels. Fifth, smart money quietly hedging their positions. But here's where it gets really interesting. If you understand what's happening, there might actually be opportunities to profit from this situation, regardless of which direction Nvidia's stock moves. Let me walk you through 3 possible scenarios and how each one could play out. Scenario 1. The bubble continues inflating. Nvidia reaches $200, $300, maybe even $400 per share as AI mania reaches peak hysteria. In this scenario, the eventual crash becomes even more spectacular. Scenario 2. The stock trades sideways for years as earnings slowly catch up to the valuation. This is actually the best-case scenario for current shareholders, but it means zero returns for potentially a very long time. Scenario 3. Reality hits, and the stock experiences a significant correction. This could happen due to competitive threats, regulatory action, economic slowdown, or simply profit-taking by institutional investors. So how should intelligent investors navigate this situation? Here's my 3-part strategy. Part 1. If you own Nvidia, don't panic sell, but do take some profits. Nobody ever went broke taking gains off the table. Part 2. If you're thinking about buying, wait for a better entry point. Great companies often provide multiple opportunities to buy at reasonable prices. Part 3. Diversify your AI exposure. Don't put all your eggs in the Nvidia basket. There are other ways to benefit from the AI revolution without taking on concentrated single-stock risk. Now, the million-dollar question: when will this bubble burst? The honest answer is nobody knows. Bubbles can persist much longer than anyone expects. The dot-com bubble inflated for years before it finally popped. The housing bubble seemed unstoppable until it suddenly wasn't. But here's what I do know. The longer a bubble persists, the more painful the eventual correction becomes. And just so you know, I'm not just talking. I'm putting my money where my mouth is. I've been gradually reducing my position in Nvidia over the past few months. Not because I think it's a bad company, but because I think the risk-reward equation has shifted dramatically. Here's what really concerns me. When Nvidia eventually corrects, it won't happen in isolation. The entire tech sector, and possibly the broader market, could get dragged down with it. We're talking about a potential wealth destruction event that could dwarf previous market crashes. When you have this much speculative capital concentrated in one sector, the unwinding process can be brutal and swift. So how do you protect yourself? First, make sure you're not overexposed to any single stock or sector. Second, keep some cash on the sidelines for when opportunities present themselves. Third, consider hedging strategies if you have significant tech exposure. But remember, every bubble creates incredible opportunities for patient investors. When the dot-com bubble burst, it created once-in-a-lifetime buying opportunities for companies like Amazon, Google, and Apple. The key is being prepared to act when others are panicking. Look, I get it. It's hard to be cautious when everyone around you is getting rich. FOMO is a powerful emotion, and watching Nvidia climb higher every day tests even the most disciplined investors. But remember this. In investing, it's not about being right all the time. It's about managing risk and living to fight another day. Here's something that might surprise you. Some of the best investors in history have missed out on major bubbles entirely. Warren Buffett largely avoided tech stocks during the dot-com boom. Did he miss out on gains? Absolutely. Did he also avoid the devastating losses? You bet. At the end of the day, successful investing is about compounding wealth over decades, not chasing quick gains. Nvidia might double from here, or it might get cut in half. But if you're diversified, disciplined, and focused on the long term, you'll be fine either way. But if there's one thing I want you to remember from this video, it's this. When everyone is convinced that a stock can only go up, that's usually when it's most dangerous to own. If you found this analysis valuable, I'd love to hear your thoughts in the comments. Are you bullish or bearish on Nvidia? How are you positioning your portfolio for what comes next? And if you want to stay ahead of market moves like this, make sure to subscribe and hit that notification bell. I'll be watching Nvidia closely and will update you as this situation develops. Remember, in investing, it's not about being the smartest person in the room. It's about being the most prepared for whatever comes next. And right now, with Nvidia's valuation breaking all reasonable boundaries, being prepared has never been more important. The question isn't whether Nvidia will eventually justify its current price, it's whether you'll still be in the game when it does. Stay smart, stay diversified, and most importantly, stay disciplined. Because in this market environment, the biggest risk isn't missing out on gains. It's not being ready for what happens when reality finally catches up to valuation. Thanks for watching. And I'll see you in the next video where we'll dive deep into the specific strategies professional money managers are using to navigate this unprecedented market environment. Trust me, you won't want to miss it.